Welcome to the Harvest Financial Advisors Quarterly Video Update. I'm Marc Henn, President of Harvest Financial, and this update is for the quarter ending September 30th, 2023. In this video update, we will be looking at what has transpired over the previous quarter, where we see the economy currently, and lastly, how this will impact markets into the future. As you may know, I enjoy using analogies when I discuss financial topics, and probably because of growing up in farm country in southwest Indiana, I prefer using analogies involving farming and gardening. As we head into October, we are smack dab in the middle of harvest time. In my last video update, I briefly mentioned how I had planted a fig tree last year. I was amazed at the growth the tree put on this year, with some new branches growing up to 5 feet. In September, the tree was loaded with figs, but as it continued to grow, I noticed that none of the figs were ripening. I needed to pinch off the tips of the branches to stop the tree from growing and to force it to put its energy into ripening the fruit. If the tree was allowed to grow unconstrained, the boughs would bend lower, the figs would remain inedible, and I would not get to enjoy the benefits of my hard work. Now, a market that puts on a fair amount of growth also requires pruning from time to time to keep it from getting too far out of whack. Now, that's a technical term we use here, and we experienced that this past quarter. In fact, even in the strongest bull markets, it's typical to experience 1 or 2 pullbacks per year, which can range from 5 to 7% and maybe even up to 10%. As I mentioned in my last update, we thought that technology companies were fully valued at that time and that we would like to see the breadth of the market widen. Like my fig tree, technology stocks, among other overvalued companies, were clipped in the third quarter, hopefully leading to a healthier market. In addition to equities pulling back this quarter, we saw a quick move in intermediate and long-term interest rates as well. By example, the 10-year Treasury jumped from 3.81% at the end of June to 4.65% as of this writing. This is important as higher rates will force prices of quality bonds down. Now, the picture I typically draw is one of a teeter-totter with prices of bonds on one side and interest rates on the other. And as rates go higher, it's easy to see with this illustration how prices of bonds go down. We've also seen a jump in oil prices this quarter, with West Texas Intermediate going from under $70 a barrel at the end of June to over $92 at the end of September. I've mentioned to some of you that we may be in a new super cycle for oil prices where we could see prices trade in a higher range for a significant period of time. Looking at current economic conditions, the economy is still growing, but at a decelerating rate. We also see a plethora of economic data that is, quite frankly, all over the place. What typically happens as we go through economic cycles is definitely not happening currently. The elongation of the cycle that I referenced in the last newsletter is still occurring. At this point, it looks like we could see the economy bottom in the latter half of next year. However, we have different data points that point to a low at the beginning of next year, and still others that point to a bottom in the first half of 2025. Once again, why is the timing of this so important? Because typically the stock market cycle bottoms 6 to 9 months prior to the economic cycle bottoming. We believe one of the biggest risks is the Federal Reserve's push toward their mandated 2% inflation target. If they truly want to get there, they will probably need to slow the economy further. And for the past year, we have mentioned that we believe the Fed will back away from its 2% target, whether in its comments and actions or just in its actions alone. And to this end, Austin Goolsbee, who's the president of the Federal Reserve Bank of Chicago, gave us a glimmer of hope as he stated the other day that the Fed may need to revisit its 2% mandate. Backing away from this should have a positive impact on markets. Now, inflation is still front and center for the Fed, and while in certain areas inflation continues to decline, it remains stubborn in other areas such as the labor market. Furthermore, the quick rise in energy prices this past quarter does not help in our bid to get the Fed to stop raising rates. The consumer is still healthy, and we could even see a slight rise in retail sales toward the end of the year. However, the trend is towards declining sales in 2024 before rebounding in 2025. Link this with higher inventories for business, and we could see more potential items on sale next year as businesses need to move inventories. a potentially welcoming sign for many inflation-weary shoppers. Other potential headwinds include the economy not yet feeling the full impact of higher interest rates, the inverted Treasury yield curve, the potential impact on regional banks of the commercial real estate market, and tightening credit. And while many sectors are on the backside of this business cycle, one of the positive signs we see, according to ITR Economics, is that single housing starts, which leads the economy, are in a recovery phase. And while this is positive, we recognize that housing affordability is still an issue for consumers. Also, real personal incomes are at record highs and will probably remain there because of the tight labor market. Looking ahead for equity markets, we could see additional volatility during the first part of the fourth quarter, with a potential rebound towards the end of the year. During upside movements of the market, we would like to see the breadth of the market widen, allowing market gains to be broad-based across multiple sectors. In fixed income markets, we see traditional bonds now struggling with a quick rise in interest rates, while our protected positions continue to perform well this year. In summary, it's not surprising to see equity markets take a breather based on the current state of the economy and with the rise in markets so far this year. Our equity and especially our fixed income portfolios continue to perform well, and income in the portfolios is still climbing on average, with the expectation that this will continue. As always, we will continue to take advantage of price fluctuations to add value to the portfolios. And if you have any questions, please let us know. And as always, thank you for your trust.